Money FM 89.3. Best of breakfast. Companies to watch.
All right, what's hot or not with Dan Koh, at least on the stocks front? Dan, what have you got for us today?
Yes, Ryan, today we're turning over to the banking sector on companies to watch. So find out with us whether this is going to be hot or not. Okay, 8855-0893. Text us. Tell us, what do you think? Okay, HSBC, Ryan, is back in the headlines. Not for a merger in London or business exit, but to take over Hang Seng Bank entirely.
Yeah, these days when I hear about HSBC in the news, it's typically for a wrong reason, because they've been struggling for a long time trying to turn around the business. And for various reasons, it's always in a negative light. So what have we got today?
Yes, so HSBC, it does seem like they've recently proposed to privatize Hang Seng Bank, offering about 155 Hong Kong dollars per share for the 36.5% minority stake that it doesn't already own. So that would pretty much value Hang Seng at around 106 billion Hong Kong dollars.
Wow, so it's going to buy out its Hang Seng unit for $14 billion.
Yes, entirely. And it does seem like, they're paying it at a premium because, HSBC currently holds about 60 to 63% of, the Hang Seng. And it's quite meaningful to some investors. After all, it's trading at roughly 30 to 33% above recent trading, which shows that HSBC still wants to ensure minority shareholder support. So it's also important to HSBC that they keep the Hang Seng brand alive, maintain its branches in distinct businesses, all while integrating back office functions and simplification.
Okay, so it's a big bet on Hong Kong, pretty much just showing its commitment to that market.
Yeah, and also goes back to roots, I guess. After all, they did also have some history with Hong Kong.
Yeah, I think when you talk about HSBC, it is a business that's been evolving, or at least adjusting. It's been scaling back on a lot of markets in recent years, and now they are readjusting or reprioritizing what is at the top of the list. And it looks like Hong Kong is up there right now.
Yeah, certainly so. I mean, the HSBC CEO did frame the transaction as demonstrating HSBC's confidence in Hong Kong's status as a global financial center and its role as a super connector between international markets and mainland China. So a bit of a strategic move there, I'd say. But it does seem like market reaction was rather mixed. We've got HSBC's shares dropping about 6% in London after the announcement, which reflects concerns around capital dilation, buyback suspension, and valuation as well. Now, meanwhile, on the other hand, Hang Seng Bank's shares had surged more than 25% following the announcement of the privatization plan. And that's despite the company being under pressure for much of this year. I mean, we're seeing how its impaired loans have risen, and it already has begun a job cut program, trimming about 1% of its core staff as it tries to optimize costs. So it does seem like it's high stakes all in play by HSBC on its Hong Kong franchise. And based on its stock price, it seems like, HSBC has been performing fairly well, I'd say. About £1,000, up about 27% year to date, Ryan.
Yeah, so it's been benefiting to some extent from some of the job cuts, the cost cutting. So that's been helping the business overall. So that's been playing out in the past few years.
Yes, that is the case. So let's weigh in here, Ryan. The bull and the bear case of HSBC, and how much would this actually work out for them? Well, first things first, let's talk about the bull case. The first point would be the fact that it's simplified capital and margin accretion for the HSBC, right? By owning about 100% of it, HSBC eliminates minority interest drag on Hang Seng's profits. So over time, the earnings and margins from Hang Seng would feed directly into HSBC's results without any carve-outs. So it's pretty straightforward in that sense. Now, it's a strategic reinvestment in the Hong Kong core as well for HSBC. After all, they did signal long-term confidence within the Hong Kong banking market. So despite headwinds in the property sector, having full control would allow it more flexibility to manage risk, cross-border flows, as well as invest in tech. So the third point of the bull case would be the fact that premium paid now might also translate to upside in consolidation. After all, if HSBC can successfully streamline the operations, reduce duplicate cost bases, the premium may eventually pay off over a multi-year hold period, and minority shareholders would also then again get immediate cash returns. So on the case of the bear, well, valuation stretch and capital strain might be one concern. After all, the premium is expensive. Expect its CET1 capital ratio to be reduced by about 125 basis points. So to fund this, they're suspending share buybacks temporarily, which could in turn, I guess,
that's a very
turn away
important
investors.
point because a lot of HSBC investors buy the stock for its dividends.
Yes.
So now with this big deal on the table, suspending share buybacks for the next 3 quarters, it's going to change the attractiveness of the stock, at least in the near term.
Certainly so. The income that they're getting or investors are supposed to get might get strained. So that might be a concern. Now, credit and property risk in Hong Kong and China still remains. So if they are not able to navigate this crisis, after all, Hang Seng has been hit quite badly by the property sector. And if it continues to deepen, that could be a drag to HSBC's profit margins. Now, execution risks and integration risks still remains as well. After all, having to integrate and to completely, acquire a company that is not exactly doing very well. But this could potentially mess up and hurt both the Hong Kong business and the global brand if it's not executed correctly.
Yep, great plan does not necessarily play out if you don't have the execution.
Exactly. So while it's one of the boldest moves in years, I guess, Ryan, the verdict for me for HSBC's deep bet is still a nod. It's a tough one for this one. Yeah.
Depending on where you see the glass, half full or half empty, it's a great plan to try to make HSBC great again, so to speak.
Yeah.
But execution is key.
Yeah.
And I think investors are going to be a bit worried about how it's going to play out, especially with all the cost cutting potentially when you have, these M&A deals going on.
Yeah, most of us might feel like it might be on the fence, and that's what we're seeing on TipRanks, Yahoo, and Barron's after they've given it a hold rating for HSBC today. That would pretty much do it for our analysis of today's stock in focus, HSBC. Now, Ryan, here's some fun facts about HSBC. Do you know the lions that sit outside of the bank?
No, what about it?
Have you seen the lions?
I vaguely
They're
remember
more than just decoration.
Okay.
Do you know what their names are?
Oh gosh, they've got names.
Yeah.
Simba.
Close, Ryan. Starts with an S. It's named Stefan and Stitt. So they believe, or people in Shanghai believe, that, by stroking the lion, it gives power and money that would eventually rub off.
Gosh, who came up with that?
Yeah, I guess, right? What did $1 say to the other?
How are you doing?
Hey, Bill. Okay. What do you call a deer that costs only $1?
$1 bill?
$1.
Oh, gosh.
And that's all we have for HSBC.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3